Okay, we are live. Welcome back, everyone, to another live stream. Fortunately, I could not make a live stream on Thursday and on Wednesday. Some unfortunate event happened, so apologies about that. But this is also a first live stream for the Aftermarket party. Of course, there's still 12 minutes left, so we're going to have a look at what is happening in the markets right now. And then if you've got some questions, we're going to talk about, well, we're going to try and answer your questions, look at some specific companies that you are asking for. Someone, Drew, now I remember the name, Drew, in the last live stream asked about Cooper Standard. I like the company, and so I covered that in yesterday's video. Now, with regards to the markets right now, of course, by the way, join in, hit the like button, write in the comments if you can hear me, if you can see me, how's your day going, plans for the weekend. Join in. This will be an hour long or something like that. So we have time to discuss plenty of companies. So right now, we can, let me full screen this for you. Voila. Right now, the markets are basically flat-ish, let's call it. Yeah, flat-ish. The companies that I follow are flattish as well, 0.19%. New Bank, New Holdings is outperforming today, up 3.82%. PayPal is outperforming today, 2.82%. Nvidia up 2%. Unity up 1.89%. AMD 1.74 now. So definitely you have some companies that are outperforming. Those that are underperforming are Alibaba, well, because yesterday they were outperforming. So Alibaba down 2.2%, SoFi down another 2.2%, Square is down 2, Roblox down 2, Palantir 1.5. If you want to talk about Palantir, let's do that. HIMS, after a quite good start of the year, down another 1.36%. They were at 9.5 or so, $9.5 or so not so long ago, a couple of days ago. But I believe because of, well, that huge company will also offer weight loss pills, but I don't think that should hurt HIMS quite a lot right now. So yeah, these are the companies that are red, but plenty of companies that are green as well. Tesla basically flat-ish today. What else did we have today? We've got the job market. So the US economy added 216,000 jobs, shocking Wall Street yet again. Yeah, interesting. Very interesting. Cheyenne asks here, sorry if I butchered that name. What's your take on AMD current valuation compared to near-term future growth for AI data center processors? The whole industry has an annual CAGR of 75%, estimated to be 75 billion market in 2024. Well, we did compare AMD to Nvidia. We did compare AMD to Nvidia not so long ago on a live stream, and we found out that Nvidia is cheaper than AMD. So there is that. That doesn't mean that AMD is not a good company or a good stock to hold. Just the big comparison right now, since Nvidia is the leader in that market, AMD far behind, but number 2, should I say. But AMD will be facing, in my opinion, some pressure from Intel, that's for sure. Again, that doesn't mean that they won't perform well, just something to take into consideration. They had their fun. Definitely in the last 5 years. I mean, the stock is up 573%. Rightfully so. Great turnaround, taking market share from Intel, CPU, GPU, data center. They're doing the right thing. But yes, sometimes you do have to look back and say, maybe maybe Intel is coming back. Maybe they will take some market share, but I do think that this market is growing so much that there is place for a couple of players, in my opinion. So yeah, that's that. What else do we have here for you today? So in the last 5 days, yeah, we haven't started 2024 on the right foot for the markets, but I rather see that than the end of the year crash. I think this also offers better opportunities. Maybe we can we find here the Palantir, because I know there's another analyst today. So yeah, here, back. Oh, this is much better. Okay. So yeah, Palantir Technologies shares dropped nearly 4% in pre-market. Right now, the stock is down only 1.42%. 1 second here. Question again. Eventually, Intel will have the edge with all their manufacturing fabs being made, meaning much better margin due to lower cost. Yeah, but it will take some time because these fabs take a lot of capital to build. It takes a lot of time to ramp up, and then some people are saying that eventually Intel will have to split the business if they want to attract many big customers. Because imagine Intel will still be selling their own GPUs, CPUs, data center chips, while also being a foundry selling to their main competitors. So you might see why some competitors do not really want to use Intel's foundry. And so that's why some analysts are saying that eventually they will have to split the business. We'll see. We'll see if that eventually happens. Even if it happens, I mean, you'll still own a piece of that business as an Intel shareholder. So yeah, there is that. So Palantir shares dropped as Jefferies downgraded the enterprise software firm, noting the artificial intelligence story surrounding it is overhyped. We've heard that before. Whether it's true or not remains to be seen. While we do believe the company has an AI technology advantage, in the long term, we are concerned that the stock has rallied to unsustainable valuation levels, primarily on the back of AI euphoria and retail trading momentum, with no clear monetization strategy. So, here again, like we've seen with SoFi, this is an issue with the stock, not an issue with the business, which again begs the question, is this an analyst an investor or is it an analyst trader? Doesn't make any sense. Also, why wasn't this released when the stock was at $20, right? Just seems strange to me, but of course, price drives sentiment. As always, we've seen that in the past as well. Stock goes up and up and up. Suddenly, you see price targets to the moon. Stock goes down. Suddenly, price targets get reduced, even though nothing has changed with the business. Okay, we already know how this game is played. Hi, Fabio. How are you? I hope you're all having a wonderful day so far. He continues here by saying we are still fundamental fans and believe that the company has potential to gain share in an under-penetrated and large total addressable market, but think concern over top-line growth will be the primary driver of stock performance over the next 12 months. Again, this here, top-line growth concerns, is not something new. I've talked about this on this channel a lot. Arnie has talked about this a lot as well. Plenty of others that talk about Palantir that are not pumping and dumping have talked about this before. We know we need to see accelerated growth for the company. Now you're going to say, yeah, but now we are profitable. Well, we are barely profitable, first of all. So any tiny hit will bring us back into being unprofitable. Also, we are profitable thanks to net interest income. If interest rates drop, then they'll have to substitute that gain with core business profitability. This is a concern. This is something we knew. Nothing new here. And then he lowered his rating here on Palantir to underperform from hold and put a $13 price target on the stock. And to be honest, I very much welcome $13. Might want to increase my position if that ever happens. There's some more info here. He noted that the AI story around Palantir is likely overdone. Till conceded, however, that the company offers a highly differentiated platform that companies can use their specific data analytics needs. The key issue, though, is whether it can get out of its own way, as it has faced some execution problems in recent memory. That is also very true. That's where boot camps come in. Palantir has faced some execution issues over the past several quarters, with growth stalling in both its government and commercial businesses. We believe the key debate is focused on whether Palantir can solve its go-to-market problem and reaccelerate US commercial growth, which is its largest growth opportunity ahead. Again, I agree. He doesn't even say anything that I disagree with, besides the first thing, which makes this note a nothing burger. Yes, the stock has gone up. So what? Why not wait until the next quarter and guidance for 2024? To me, it just doesn't make any sense. Maybe those analysts have to put out notes on some companies at the start of the year for their clients. So, hey, they're picking those types of companies. Can be. But other than that, really, to me, there's nothing new in this note. There's nothing that will make me sell my shares. If it goes lower, great. I'll add more. If it doesn't, it doesn't. Fine, I have my position. We'll see what the next quarter brings, and we'll move from there. Let me update maybe the title of this live stream to attract some more people. Tack. Okay. Okay, markets are closed, and we have closed. Oh, we have closed the greenish Dow 0.07%, S&P 500 0.18%, Nasdaq 0.09% as well. Okay, but overall this week, not such a great week to start the year, but hey, we ended 2023 pretty strong. So there you have it. Other than that, yeah, new holdings finished the day up 4%, PayPal 2.87%. Maybe this is a start of something new. No pun intended for new holdings. SoFi was the one that was down the most in my list here, 2.26, Alibaba 2.24. Interesting. Hold back under $12. Okay, other than that, nothing special, to be honest. Nothing special. Let's see if we can find something extra. Let me check on X for a second. Let's see what we can find. Let's see. So I think someone posted something else about Palantir. I'm not sure. I've seen. Maybe it's on Reddit. Maybe not. I don't know. Anyways, everybody joining, welcome. Make yourself comfortable. Ask questions. That's why we do these live streams. You can ask questions. If there's a great company you want me to cover, like we've done actually this week, which was Cooper Standard, let me know. Oh, I found it. I'll show you in just a second. Just want to listen in. Up. Okay.
Only defense is very hard. Eric, you have to basically be like 10 times better on the product side to break in. Then you also have to be really good at playing the game in DC. So when I was 21, building Palantir, we were like more than 10 times better on the product side. We can save the government billions of dollars. We can catch bad guys they wouldn't catch otherwise. We can make everything work together with protect civil liberties. Like, we're just way ahead of anything they'd done. We had no idea how to play the game in DC. So it took us a long time. And it was very frustrating. Eventually, if we got to the point, we're still not the best at Palantir, but we got to the point, there's $2 billion revenue, half that's in global government. I mean, it's a good company. It's doing really well. Anduril, which was started by 3 of my best Palantir guys with Palmer Luckey, like, they kind of had already learned all the lessons. Yeah. And they'd also seen like giant gaps in defense hardware software side. So they said, you know what, we could be 10 times better in this other area, kind of shame the government having to work with us here. And now we know how to play the game on the Hill. Totally. So that was great. So they grew really fast. I started the company out of AVC called Epirus. And another gap I saw, which is that basically electronic warfare systems were not deploying kind of modern technology from Silicon Valley. And it turns out if you use AI on a chip, you can control power on nanosecond timescales to hit the electronic warfare emitter. So you can actually make these electronic warfare systems shoot 10 times farther for the same amount of power. And this was like a pretty cool thing. My friends and I did it. We proved it. Took us about $30-40 million to prove it. We just won a giant contest. These other competitors, that, L3 and Raytheon, Lockheed, they do a lot of good stuff, but their systems they spent billions of dollars on, and ours literally shot down the drones 9 times farther away in the contest, in the field. Wow. We got our first big contract a couple months ago. Epirus is named after the bow of Theseus, which had infinite arrows. This thing could shoot like millions of times because it's shooting blasts of microwave energy to turn off bad guys far away. But it's just amazing, like, how much better you could be with a small group of people than these big companies, and that should scare everyone because there are bad guys in the world. Yeah, there are really smart engineers working for the bad guys. So America had this advantage in the in the 20th century, really late 19th, 20th century, because we had this massive industrial base and we could spend more money. We'd have more tanks, more planes, more missiles, whatever. That's not really what warfare is about as much anymore. If you could have technology, like if you could have little tiny like drones and androids and things that turn things off and tiny little ships and that run all around and coordinating and that are like 100 times smarter than these giant things, like you could have like a tiny country wipe out a bigger country's military, right? It's very asymmetric these days. And so it's really important that America partners with its elite top technologists and brings them in. And that's what I've been trying to do. So listen, I think 8 companies have actually made it to become unicorns in defense the last 25 years. 2 of them I started, 3 of them were started by people I backed early. So I've been pretty involved in that side of things. It's one of our 5 big sectors. And I don't like owning big defense companies at scale because I think it's like a super weird crony industry where you have to go schmooze people and get contracts. So I've actually sold out when these things get big. Like I start them, I get them to be successful, have the right impact, and then I mostly sell out. Like I sold, I'm not supposed to say too much, but I've sold. I'm still very bullish on Palantir, but it's not my main economic thing. Just because and Palantir is still doing really, really good work, but it's not fun for me to play that game at scale. It's fun for me to start the new best things and scale them up and make them functional.
Makes a lot of good points. And this is something we've heard before, right? From Palmer Luckey at Anduril. I mean, that's why Palantir made FedStart, right? It makes it much easier for smaller companies to deal with the government to get access to impact level 5, impact level 6, which previously would cost you millions of dollars, a lot of time. And yeah, it's true. Alex Carpet said it himself. Been years and years that Silicon Valley did not want to help the defense industry, right? Because, Silicon Valley, fancy schmancy people, we don't want to get attached too much to that defense industry. Well, protecting America, American dream. No. We want to talk about tech. We want to talk about culture and BS. Okay, then that's why these little guys, great companies, come in, and now that they have the opportunity to work with the DoD, government, whatever, you will see things change extremely fast. And these companies get access to huge contracts. And I mean, like you said, they can create great technology, even technology that outbeats the big guys, L3Harris, Lockheed, stuff like that. We're going to see more of those stories pop up in the years and years to come. Palantir is certainly a winner when in that regards. You have a question here, actually. It's not a question, it's more a comment, but okay. It's really interesting times because the job reports today indicated an economy that's too strong, which removed recession fears, but increased higher for longer fear. Yeah, it depends. The higher for longer fear really depends on inflation, on the inflation numbers. If it continues to go down, then I don't see why we have higher for longer. But yeah, strong job market has been the case for quite a while now. And vice versa, if things went the other way, rate cuts would get priced back in, but now there would be recession fears. I mean, there is still a gap between soft landing, hard landing, right? Recession fears. I mean, for a recession, you really need to see bad numbers, bad momentum, which currently we're not seeing, but it can change. It can change quite fast. Don't forget, election year, political games, stuff like that. I mean, if you can go on the podium and say, oh, look at the economy right now, look at inflation, I made this happen, or vice versa, right? Or look at the economy, look at inflation, horrible, this guy made it happen, don't vote for him, etc., etc. So yeah, we'll see what happens. But at the end of the day, you're not buying a stock for a year, you're buying it for a long time. So we'll see what happens. Let's go back here and see what we've got, how we finished. There's something interesting. I think I saw something with Apple. So Apple is down 0.45%. Okay. Market cap 2.83 trillion, which I think is closer and closer to Microsoft right now. So that's okay. Apple, Alphabet, Broadcom, Nvidia CEOs to meet with EU antitrust chief next week. Can't wait for the EU to put even more rules on American tech. It's truly remarkable. Truly remarkable. But yeah, if you have anything you want to ask me, let me know in the comments, in the chat. I'm trying to find something that I saw before, but I don't seem to find it. There was something about Palantir and Snowflake. Here, found it. So, can you see? Yeah, you can. Okay, great. This is from Garcia on X. Go show him some love. So apparently, United Healthcare is building an in-house data platform on Snowflake. This was shared on, I presume, Reddit. Been tracking United Healthcare for a long while. As to me, it's the most important healthcare company to land in the United States. When looking through job listings on Optum, their primary care arm, I found a position for a lead software developer to build an in-house data analytics platform on top of Snowflake. In addition to this, there seems to be 7 more roles around this venture. At this time, I think it's safe to say Palantir has lost out to Snowflake on United Healthcare. For now, let's hope they fail to build in-house. Okay. I didn't even know Palantir was in talks with United Healthcare or works with them. So just, I think, an assumption here. Palantir hotline, not lost. They were never a Palantir client. They had an existing relationship with Snowflake for data warehousing and were convinced with PowerPoint and steak dinner to build full-on data platform. They'll come back around when they see competitors succeeding with Palantir Healthcare. I mean, again, this is an assumption made here. Maybe it will work out. I don't think Snowflake is a PowerPoint type of company. I think Snowflake is a pretty strong company. I mean, if you look at their growth, they're growing quite fast, and rightfully so. So we'll see. We've got here a list of Bank of America. So Salesforce, Microsoft, ServiceNow are Bank of America's top software stocks for 2024. Software stocks are not inexpensive after having gained 58 last year, 58%, I presume, but it's still likely that the business cycle is in the early recovery phase, according to that analyst. However, we remain positive on the sector due to secular tailwinds from the newest AI wave, improving IT spending, and the continued shift to the cloud. This is definitely one of the main reasons. The continued shift to the cloud still going to be with us for many, many years. We expect mid-teen revenue growth, improving margin, multiple revisions, and positive revisions to offset cyclical headwinds in the first half of 2024 before driving a stronger second half of 2024. For Salesforce, the analyst sees enduring revenue growth in the mid-teens and rising margins thanks to increasing productivity efforts in sales. Remember when Salesforce was dead, quote unquote? That was fun times. Microsoft is likely to benefit from AI and see incremental growth in both Azure and Office thanks to AI, of course, with Copilot as well. I think that will be a big growth driver. The Satya Nadella-led company should also see margin and free cash flow growth as it reaps the benefits from scale. ServiceNow offers a best-in-class growth. ServiceNow is a company I bought for my father's portfolio, I think in 2017. I regret not buying it for my own, but you live and learn. So ServiceNow offers best-in-class growth and is likely to see that growth rate move higher thanks to AI and ongoing consolidation of the large IT and custom apps market. Oh, HubSpot is in that list as well. Interesting. So that was also mentioned as a buy for 2024, with the analyst saying easing macro concerns could result in revenue reacceleration for a small and medium-sized business customer relation management company. Unity, Oracle, and Twilio are also mentioned here. So Unity was also mentioned favorably due to estimate upside, better industry trends, and compelling valuation, while Oracle and Twilio were mentioned in a negative light due to concerns about cloud migration and secular headwinds, respectively. Okay, interesting list. Interesting list. What did the famous useful currency do today? Down 1.62%, big deal. Last year, it's up 160%. In the last 5 years, still up 3.5%. Month, 4.4%. Okay, so I don't see why people are complaining that much. But then again, it's the Bitcoin crowd. If it's not in $100,000, they'll always complain. So there is that. Let's see, what can we find? Well, that's quite long, too long for the live stream, so I'm not going to read all of that. Maybe the Yahoo Finance people can. Let's see what they have to say.
Let's talk about the markets in 3 minutes then, Mark, and we'll begin on the jobs report as we approach this first big data point, I suppose, of the year. What are you looking out for?
I think that there's a couple of perspectives in this jobs data. So one is, our colleague John Arthur has done this piece kind of saying that the participation in this jobs data is so low nowadays that it's providing less information. that's dangerous because it lets people open up to kind of either dismiss it if it doesn't suit their view and gives it more kind of volatility and erraticness. On the flip side, Anna Wong, chief US economist for Bloomberg, who's generally been exceptionally over the last couple of years in calling the cycle much better than average out of economists out there. She has always maintained that she thought that US would go into recession around the turn of the year. And she's saying, look, actually the jobs data out there is indicating we might already be in recession. And she's talking about some of the cyclical indicators, sorry, the most cyclical sectors of the economy are already seeing job losses at a rate which would indicate around the start of a recession or just before the start of a recession. So I think that's a very interesting dynamic today that I'm going to be watching for.
Okay, so cyclical sectors and job losses there, looking for further evidence of that, perhaps. I'm thinking about market positioning going into the jobs report as well. Interesting story on the Bloomberg terminal talking about one large options trade that's targeting a yield as high as 4.15%. We're around 4% on the 10-year right now. So clearly somebody expecting yields to pop a lot higher here. What do you think about positioning on that front ahead of this jobs report?
I mean, we've still got a Fed, which is only promising 3 rate cuts this year and doesn't want to promise more aggression than that anytime soon, and is unlikely to until we get to March, which means that unless the data starts validating the aggressive pricing of which was close to 6 cuts being priced only a few days ago, unless data starts validating that soon, the natural convergence over time will be those rate hikes to slowly get priced out. So it makes sense that the skew is much more asymmetrically set up for a bigger yield bounce than for a yields fall, because the market has already bought into the idea of an extremely aggressive Fed pivot and much more than the Fed themselves are promising.
Okay, so that's interesting. Yeah, there was such an aggressive buy-in to that Fed pivot view that we got post the last Fed meeting, wasn't there, back in December of last year. Mark, are you nervous about a lack of participation in markets or a lack of volume in markets on a day where we're getting an important data print? And I say this because there are plenty of signals. My favorite is, low number of unread emails in my inbox when I get up early in the morning. There are plenty of signals that not everybody is back at their desks just yet.
No, that's definitely the case. Look, I always hated non-farm payrolls. When I was trading, it used to be my worst day of the year. As I got more senior, I learned the idea is that actually just to go away from non-farm payrolls and come back a few hours later to then make the assessment, because the price action afterwards is always terrible. So yes, if I was a trading seat today, I'd be absolutely dreading it because there is low participation. We're skewed for a market that really could move quite dramatically either way. And I think there's a lot of uncertainty about what the theme is for the rest of January. Fortunately, I'm not in that trading seat anymore.
Thank you very much for that useful information. You're asking here, was loud. You're asking here, have you heard about extreme networks? Should further benefit from AI? What do you think about it? Greetings from Germany. Guten Abend. I have not heard about that company. Well, let's have a look in just a second, because this guy asked here about Snowflake going to 600 as outlook by Yahoo Finance. I don't see the average price target sits at $218 right now for analysts, which is only, well, not only, it represents a 15.63% upside. So there is that. Forward PE 202.6 times, cheaper than before, by the way. But of course, this is a company that is growing quite fast. If you look here, I can't really zoom in, but if you look bottom right, if I remove this, you can see that for fiscal year 2024, EPS is expected to grow 214%. A year later, another 43%. A year after that, another 54.46% growth for EPS, not sales, but EPS. So yeah, it deserves a premium. Depends really how much of a premium you want to give this company. It's $62 billion market cap, generates $2.8 billion in revenue. So yes, not cheap, not cheap at all. Then you said extreme networks. Okay. Let me just look at what they actually do. So Extreme Networks provides software-driven networking solutions worldwide. It designs, develops, and manufactures wired, wireless, and software-defined wide area network infrastructure equipment, The company offers extreme cloud IQ, machine learning AI powered wires. Okay, blah, 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 blah. Okay. That's what they do. Market cap $2.22 billion, forward PE 12.1 times. Not that much, it seems. I mean, not that expensive. If we look at their growth rates here, bottom right, sales growth, single digits for fiscal year 25-26, 8%. But EPS growing much faster, 26.5% in fiscal year 2024, and then another 20.4% the year after that, and then another 15.83% the year after that. So you're basically paying, I would say, 8 to 9 times fiscal year 2026 earnings. Okay, not that expensive. Let's see what the analysts are expecting. Average price target $22.14, which is an increase of 30.26%. I mean, represents an upside of that much. If you look at valuations right now compared to its mean, 5-year mean, that is, can we do 10-year? We can. It is cheaper. It is cheaper. EV to EBITDA much cheaper, 8.2 times. Price to earnings, 12.1 times compared to 16 times. Price to free cash flow, 8.5 times compared to 20.7 times. So definitely intriguing. Definitely intriguing. Shares outstanding have gone up throughout the years, but free cash flow per share has increased in the last couple of years. So that's nice. The EPS estimates for the 5-year growth rates, 18.5%. So definitely something interesting here. Definitely something interesting. What's the expectations for free cash flow? So it has increased free cash flow each and every year, but apparently for calendar year 2024, free cash flow is expected to fall 8.8%. Why is that? Good question. But yeah, definitely interesting. Definitely an interesting company. Interesting company with quite a good, let's say, valuation right now. There's definitely something that has happened in 2023, right? Because otherwise, why would the stock be down that much? I mean, down that much. It's down 7% since last year, but as you can see, since August, it halved. It's down 50%. So there's definitely something that happened there. If you can tell me why that is, I'm talking to the greetings from Germany. I'm not going to butcher the name. If you can tell me why, that would definitely help. But I'll write down this company because it's definitely something interesting to look at. Definitely something interesting to look at. What's the ticker symbol? XEXTR. Okay, thank you for that, by the way. Thank you. Up next, can you look at, great name, Default. Can you look at Brookfield Corporation? They are big in asset under management, real estate, and infrastructure. Yes, I am familiar. I am familiar. Brookfield Corp. So yeah, so there's two things, right? Brookfield Corp, ticker symbol BN, and then you have Brookfield Asset Management, which is BAM. So Brookfield Corp right now, yes, I mean, I talked with someone this week about this company, which, yeah, looks intriguing. Looks intriguing. Forward PE 13.6 times. EPS growth. I mean, it's a bit strange to talk about that with Brookfield, but okay. Average price target sits only 3% higher than it is today. Free cash flow per share has come down, but I think this is because of the asset management spin-off, let's call it. So yeah, definitely. I mean, it's definitely something you can't go wrong with this one, in my opinion. It also pays a small dividend, 0.73 yield, but overall, pretty strong company. Just from a top view right now. The dividend, yeah, okay. I mean, you're getting these types of percentages here, but that's because of the change in structure. But I have to look into it a bit deeper, how the changes impact you, etc., etc. So yeah, there is that. Is SoFi going to be good in Q4? Is SoFi stock going more decline? Well, watch my latest video about SoFi, and that might answer your question. Also, I don't really have a crystal ball, so it doesn't really matter what my answer will be. We'll have to wait a couple of weeks, and then we have the earnings report. But watch the video today about SoFi. Oleg says here, looks like SoFi at 7.5 is possible next week. Cash is ready to buy. Yeah, it could be. It could be. If we go, let me just pull up TradingView. By the way, welcome. 28 people are now watching. Welcome, welcome. If we look at TradingView, so this is on the weekly. The 200-day moving average sits at 200. The 200-day moving average sits at $7.85 or so. So if we look at $7.5, that's a bit below. So yeah, if it breaks below the 200-day moving average, I think we should be looking even closer to the $7 area. This is on the weekly. If we look at the daily, I think the RSI is a bit lower, yeah, but still far from being oversold. So yeah, there is that. $8 is a round number we've seen with round numbers before, can serve as a buying area. But yeah, we'll see what happens until the earnings report. I'm using this one. I'm using Coifin, as you can see here. I'm using Coifin. There is a link in the description for 20% off. You support me, and you can use a great software. Is CLF a buy? I don't know. I don't even know what CLF is. So let's see. Cleveland Cliffs. Are we buying mountains now? Cleveland Cliffs. CLF. What do they do? Steel? Is that... yeah, operates a flat rolled steel producer in North America. The company offers hot rolled, cold rolled, extra galvanized, hot dip galvanized. Okay, a lot of steel products. Okay, cool. Forward PE 12.7 times. Yeah, so fiscal year 2023 EPS dropped 52%, but it's expected to grow year over year 48% in fiscal year 2024. Sales growth is expected to decrease for the next 2 fiscal years, so something is going on there. The average analyst price target sits at $20, representing 9.2% upside. Currently, compared to its 5-year mean, we are pretty close. PE, EV to EBITDA, pretty close. Price to sales, it's cheap, not gonna lie. I mean, 0.4 times, that's cheap. But expectations are that, well, revenue is expected to decline in the coming years, as you can see. So yeah, there's definitely something going on there. Free cash flow as well is expected to decline 27% in calendar year 2024. Again, if you ask me about a company that I don't know about, try and give me more information about that company. It would be extremely helpful. But yeah, I don't know. I don't know why. I don't know what happens. I don't know why they're down. But I mean, 0.4 times sales, definitely worth a bet, I would say. Huh. Wait. Is it okay? It's not the company that Japanese company wanted. That Japanese company wanted to buy, right? That's Steel with the ticker symbol X. Nippon Steel. So a bidding war for U.S. Steel ensued in the summer after the company rejected an unsolicited $7.3 billion cash in stock bid from rival. Okay, interesting. Interesting. Okay, so I guess that can explain it a little bit. So do you think they will acquire them or not? And that's why the market is a bit on the sidelines right now. I can understand why the US doesn't want a Chinese takeover, but a Japanese takeover of such an important company. But interesting. Why even more bullish? Let's see what this guy says. Leo Nielsen, if you're on Seeking Alpha, go show him some love. So Cleveland-Cliffs lost the bid for United States Steel to Japan's Nippon Steel, but remains resilient with a healthy balance sheet and strong free cash flow. The company's focus on aggressive share buybacks and positive industry outlook. Didn't we see that the company did not buy back shares, or did I misread that? Or maybe they announced share buybacks. That can also be. I think these guys buying US Steel due to security lag. Let's see. One of the major things that happened since then is the acquisition of United States Steel. The buyer wasn't Cleveland, but Japan. Okay, so as the stock was trading at an attractive price, it was a highly attractive takeover target. Unfortunately for Cleveland-Cliffs, which was among the bidders, Japan's Nippon Steel got the deal done, at least pre-approval. Okay. Okay, let's assume Nippon gets the deal done. It will obviously mean that Cleveland-Cliffs won't get a shot at a massive inorganic growth spurt, of course. However, that's okay. After all, Cleveland-Cliffs has spent the past few years going from a company that produced no steel to becoming one of the biggest producers after buying. Okay, so it's not a old company, I assume. A bit like those lithium companies. Okay, interesting. You have won over my interest. Let me write it down. Wait, so if it's an old company, right? If it's an old company, why is he saying here Cleveland-Cliffs has spent the past few years going from a company that produced no steel to becoming one of the biggest producers? What did they produce before? Something else? Cleveland-Cliffs. Let's see. Oh, a mining company. A mining company. A very old company indeed, 177 years old. Yeah, okay, I'll take that back. Okay. Deep ties to the US government. Yeah, if it's 177 years old, I would assume they have some ties. Okay, operates iron ore mines. Okay, interesting. Interesting. Okay. Like General Dynamics. You have, yeah, well, I have written this one down. It might or might not pop up in one of the videos in the future. Interesting company. Yeah. General Dynamics, aerospace and defense company. Yeah, okay. With a dividend as well. So 2% dividend. That's not bad. What is it? GD? General Dynamics. Okay, this is nice. Yeah, this is, buying back shares in the last 10 years, free cash flow goes up. Pretty cool, pretty good. But it is a bit expensive. Okay, probably got a little push. Probably got a little push in the last year or so, not that much. Yeah, in the last 3 months, up 17%. Market cap 69 billion, 4P 17.4%, 17.4 times. Average price target for analysts is $278, upside 9%. What are the analysts expecting? For fiscal year 2024, 7.5% sales growth, 19.24% EPS growth year over year, then another 10% in fiscal year 2025, and 4.26% sales growth. Not bad. Dividends last 10 years, the annualized growth rate here, 9%, last 3 years, 6.5%. So that's definitely respectable. So 10 years ago, you got 56 cents. You're now getting $1.32. Pretty good. Shareholder yield is basically 3 times more than just the dividend yield. Why is that? Because you get dividend yield plus buyback yield and the debt pay down yield as well. All of that calculated into the resulting 6.08%. Okay. General Dynamics, I'll add that to that list as well. Very good companies you're giving me today to look at. So thank you for that. Okay, what else? What else shall we look at? Shoot away. Give me some of the goods. Because I do want to cover more companies that you guys are interested in. I mean, I know YouTube X whatever is full of Palantir, Tesla, SoFi. I know it gets views, Neo, stuff like that, but I think it's, if I can create good thumbnails and titles for you to click on and talk about great companies, I think that, to me, that would be better. because I don't think anyone would click on a video that says, is General Dynamics a buy or is Cleveland Cliffs a buy? Most people will just not click on it and move away because, well, it's not a SoFi or Tesla or Palantir or anything like that. So yeah, shoot away with the questions. I am still in the works for a video about Expedia booking and Airbnb. Still working on Paycom. Working on Upselera, Albemarle, United Health, Paychecks, automatic data process as well. Broadcom is on the list here. So most of those companies I've never talked about on the channel. So yeah, we've got plenty of new companies to talk about in the coming weeks. What do you think about STRL? So I'll give you already an answer. I don't know, but please give me more information in the chat. That would be extremely helpful. Wow. Well, what happened here? That thing is up 143% in the last year. Sterling Infrastructure. Interesting. It engages in the e-infrastructure, transportation and building solutions primarily in southern United States, the northeastern and mid-Atlantic United States, the Rocky Mountain states, California, and Hawaii. It undertakes infrastructure and rehabilitation projects for highways, roads, bridges, airports, ports, light rail, water, wastewater. Okay, this company does everything, basically. Everything that has to do with infrastructure, transportation, stuff like that. Okay. Very interesting. Very interesting. Market cap 2.38 billion. That's it. Okay. Market cap 2.1. Okay. Price target. We only have one analyst here, so I don't really care much about that. Let's see. Okay, it is 60% more expensive right now, forward PE compared to its mean. Which again is not that expensive, but still more expensive than in the past. More expensive than in the past. Did they buy back shares or anything? No, they did not. What happened in 2016? An acquisition of some sort, probably. But free cash flow per share has gone up in the last couple of years. So, okay. Okay. We've got expectations for the coming years. So sales growth, low double digits. In fiscal year 2025, only 8.39% year-over-year growth. For EPS, we've got double-digit growth. So fiscal year 2023, 19.5%, then another 13% year-over-year, and then another 10% in fiscal year 2025. Interesting. Okay, so they did authorize a $200 million share buyback program back in December. So, okay. That's an interesting company. That's an interesting company. The software I'm using is called Koifin. This name right here. This There's a link in the description for 20% off if you wanna buy a license. That helps me out, helps you out as well. I love it. I think most of the people that have used my links are extremely happy. So yeah, do try it out. Coifin, link in the description. Amazing website, amazing software, has helped me tremendously since I've been using it, since I've partnered up with them as well. By the way, I pay for my own subscription. Just so you know, I pay for my own subscription. So I'm not just trying to push something here. Do you think it's so dry here? I hate it. Do you think Paramount and Warner Brothers merging and pooling their debt, which one is a buy? I don't know. But I'm not surprised. I'm not surprised to see consolidation in that world, in that industry. Yeah, Paramount is down quite a lot. 17.9 times 4 PE. That's just because in fiscal year 2024, they're expected to grow PE basically more than double, 120%, and then another 19% after that. Let's see what the crooks are expecting. I mean, analysts. Upside of 3.56%. Shares outstanding. Okay, we know why this happened. So yeah, I mean, let's see. So the net debt is not increasing that much, I would say. Let's look at Warner Bros. Here we have, another company that fiscal year 2023 negative EPS, but then we're growing quite fast at the bottom line. So there's that. Here analysts are expecting huge upside right now. 48% upside for Warner Bros. It's a bit cheaper. I mean, on the sales side, price to sales of 0.7 times. That's quite cheap. That's quite cheap. So yeah, interesting. We'll see what happens. Bruno asks here, what do you think about Shockwave Medical? I already don't like that name. Shockwave Medical. Market cap 7.39 billion. Forward PE 51.3 times. EV to sales 8.4 times. EPS is expected to grow quite fast in the coming fiscal years, 21% year over year, and then another 33.3%, with sales growth above 20% as well. So that's quite good. Analysts see a 16% upside in the next 12 months. Can they buy back their own shares? No, shares have been increasing. Free cash flow is now positive. Okay. Which probably means it's expensive. No. Okay. It's much less expensive right now than its 5-year mean. PE, EV to EBITDA, price to sales, even price to free cash flow. Still not that cheap, but we've seen the growth rate, so looks acceptable. Let's see. But free cash flow is expected to decrease 21% in calendar year 2024. Why is that? I don't know. But all the rest here, EBIT, net income, EPS adjusted, and GAAP, all expected to increase. So suave. So ticker, suavemente. I guess the only problem here would be maybe valuation, but that's about it, I guess. Other than that, what do they do specifically? It's a medical device company, develops intravascular lithotripsy, IVL technology, for the treatment of calcified plaque in patients with peripheral and coronary vascular and heart valve diseases in the United States and internationally. The company offers products for the treatment of PAD, including okay. The other names doesn't really make sense for me to read that, but okay, interesting. Another interesting company. Arcadium Lithium, yeah, because we talked about Livent not so long ago. I think someone asked me this, maybe you. ALTM. Doesn't give me anything. Arcadium Lithium, LTHM. What did I say? Yeah, LTHM. After merger with Alchem. Yeah, it's for the heart. I figured. I figured. Yes, so it's basically this LTHM. That's the company. Forward PE 12.3 times, 2.90, basically $3 billion in market cap. Sales expectations expected to grow, to accelerate in 24 and 25, probably because of the merger. But EPS is expected to take a hit in fiscal year 2024, but then reaccelerate in fiscal year 2025, just a bit higher than where we were in fiscal year 2023. Of course, you can see that big jump right here. I guess that's because of the acquisition. My guess would be. So interesting. Okay, this is because of what just happened, or what was because this was already in June 2022. Okay. Livent and Alchem merge into one company. Okay. Okay, fine. US company, Australian company merged together, and now they're named Arcadium Lithium. Fine. Okay. Okay, interesting. Lithium is going to be an interesting thing for the coming years. Okay. Question here. Hello, I just tuned in. I got a question. Should I go ahead and buy into Palantir stock while it's pretty cheap? Well, some people would say it's not cheap. Some people will say it's extremely cheap. I'm not here to give out recommendations because I can't give that. But how would you define it being cheap? because the stock price is now lower than $20, or because it is trading at a cheaper valuation. The business will continue to grow, accelerate. I mean, right now the sales expectations are around 20% year-over-year growth for fiscal year 24 and 25. For EPS adjusted, 18% fiscal year 24, and then another 22.3% in fiscal year 2025. Can they accelerate that? Can they grow more? Remains to be seen. We'll see. The lower it gets, the better the opportunity, because the company still has to execute quite a lot. I mean, current price target the average sits 2.2% lower than where we're at today. If you look at the expectations for free cash flow for calendar year 2024, free cash flow is basically going to grow just 1%. That's it. Cash from operations will grow 16%. Again, people need to be realistic here with Palantir. Great story, fine CEO, great product for sure. From what I've seen, I've never used it. Most of us have never used it. Let's be honest here. But still, this company has to prove to investors that it can continue to accelerate growth and work with a lot of companies, convince those companies, which have been doing with boot camps, which is great. But we have to see the results, right? Great to tell everyone that you're doing lots of boot camps, lots of positive feedback, but it's the money that talks, nothing else. Like Elon said, lithium is like permission to print money. Yes, but you have to do it in a profitable way, of course. Refineries, stuff like that. But yes, definitely. I mean, with the rise of EVs, battery packs, stuff like that, you will definitely need more and more. So yeah, it's true. A guitar guy, well, I'm fixing to put $60 into the stock and see if it grows over time. Well, if it's, I'm not going to say only $60 because $60 for some people is a lot of money, but yeah, $60 gets you 4 shares. So I mean, 3 shares, 3 and something. So we'll see. I don't think it's going to make you a millionaire, but it might increase to $100 over time. Could be. I mean, if we jump over to the graph here, this is on the daily. We are getting pretty close to the 200-day moving average, which sits at $15.25, which will mean that we are going to close this huge gap here, which was the earnings report back in November. If we go to the weekly right now, that's this huge green candle right here. Again, 200-day moving average, $15.27. Why not? And by the way, this worked out quite well for me. What I said in my previous video. I said we're going higher, yet RSI is lower, which is a bearish indicator, which worked again quite well. Took its time, but it's playing out well. I got some people that hated that video, but I mean, sometimes you have to look at the graph and say, okay, maybe the market will think about this differently than most Palantir bulls, but yeah. Look out for the 200-day moving average next week. And then as we enter earnings season, lots of things will happen there. So, yeah. I'll take a couple of extra questions if you have any. Some companies, let me know. Otherwise, I will tune out for today. It's already late here. So, and I still have to work on the Tesla weekly video, first of the year. So ask away before it is too late. What do you think about Semrush? I don't know. We'll see. Semrush. Semrush Holdings. It develops an online visibility management SaaS platform in the United States and UK and internationally. The company enables companies to identify and reach the right audience for their content through the right channels. Its platform enables the company's customer to understand trends and act upon insights to enhance the online visibility and traffic. Okay, interesting. Get measurable results from online marketing. Do SEO, content marketing, competitor research, PPC, and social media marketing from just one platform. Who are their competitors? Celebrite. Okay, let's have a look. Market cap 1.79 billion, forward PE 86.5 times. Definitely not cheap, but as you can see, EPS is expected to grow quite fast, 121% in fiscal year 2024, then another 87.6% in fiscal year 2025. Price target, probably not that many analysts, now only 6. Price target sits 9.3% lower than where we're at today. If we look at the metrics here, somehow it was much lower back in November. I don't know what happened there. But other than that, I mean, it's a bit lower than its 5-year mean, but not by much. 3-year mean in this case, not by much. Cash from operations will increase from 7 million to 20 million. And free cash flow will increase from 2 million to 16 million. Okay. Interesting. Okay. I don't know. It's not my type of company I would buy. I don't know if they have a moat, if it's something, I mean, their tech is so amazing. I don't know. I don't know anything about this company besides what I've just showed you. But yeah. Their last quarter was pretty good, apparently, from what I'm seeing right now. So interesting. Views on Interactive Brokers and Canadian Pacific. We did talk about Canadian Pacific last live stream. Don't think you can go wrong with something like that. But if you want to have a look here, Canadian Pacific and Kansas City. Yeah, we did talk about that. They acquired that company. They merged together or whatever happened there. Like I said, it's a bit more expensive right now than what it was previously. Here you're going to see that big jump. Yeah, so that's the Kansas City thing. Again, free cash flow per share over the years. Great, no problem there. Price target, the average one over 8.3%. Growth rates, again, EPS will outgrow sales with a dividend yield 0.72% over the last 10 years. Growth of 10.5%. Basically means 10 years ago you got 7 cents, you're now getting 19 cents. I believe that's what I said, that Joseph Carson, he's the one that holds this company, right? I think in his portfolio. That doesn't mean you have to buy it as well, right? But I think that's where I heard about this before. But yeah, definitely a strong company. Could be cheaper though. Are you still holding Robinhood? I am still holding Robinhood. Yes, I have no intentions of selling it whatsoever, unless they give me a good reason to sell. But right now, yes, I'm still holding Robinhood. Oh, yeah, Interactive Broker. I once worked with them. This is not stock related, but I once worked with them. Was a horrible relationship. They didn't pay me for 8 months or something, 8 or 9 months even. Yeah, ridiculous. But let's see. Market cap 37 billion, forward PE 14.1 times. Shares outstanding have basically more than doubled in the last 10 years, but free cash flow, well, it did peak here back in 2020. Since then, it has come down, but still higher than before. So, okay, well, fine. And definitely cheaper right now than its 5-year mean. Much cheaper. Much cheaper. But I guess, yeah, I mean, here is the period of the pandemic. So for sure, their revenue, everything went up like everyone else. Yeah, free cash flow peak there. Gross profit margin. Yeah, interesting company. Let's see. Cash from operations is expected to increase 108% in calendar year 24. We're not getting any free cash flow data here. Okay. Well, I think it's a solid company. Not a solid company, yeah. Why are you holding Robinhood for short term only? Because I saw the opportunity. I saw the opportunity when it was at $8. Just didn't make any sense for it to be trading so close to cash. So yeah, I bought it. The business is doing very well. So yeah, I mean, when I see such a big disconnect, I usually do a small trade. So it's usually for the short term, but sometimes it can turn into something that I will hold for the long term. Currently, it still is for the short term. What will be the reason to sell? It hits my price target, which I've put it at $20 right now. Why? Just a round number will more than double my money, and I'll be happy with that. Of course, it will only reach $20 if the business is performing well, right? If it doesn't perform well, then I'll just exit my position and be done with it. But yeah, PayPal is another one. I have a PayPal position, very good average price, but PayPal is more likely to stay in the portfolio long term if it can execute correctly. But yeah, overall, that's that. Again, before I make any moves, I'll explain on the channel. But I think I'll hold onto Robinhood for at least at the end of this year, because I don't see, unless something crazy happens, I don't see them trading at $20 anytime soon. And PayPal, like I said in the previous video, if it goes to 100 in the first half of 2024, will only happen if the company executes well, by the way. Then I'll probably sell my initial investment and let the rest ride. Again, $100 would basically mean that I made close to 100% on that investment. So yeah, there is that, Igor. Thoughts on a Visa at current stock price? Probably not cheap, right? As always. Visa, where are you? Here. So yeah, Visa, 26.3 times PE. But again, it also pays a nice dividend in the last 10 years, annualized growth of 18%. 10 years ago, you got 10 cents, you're not getting 52 cents. If we look at shares and free cash flow, shares outstanding comes down, free cash flow goes up. Look at current valuation compared to its 5-year mean, it's cheaper. But let's look at the 10-year. That's a bit closer, because the 5-year, there is that huge bump from the pandemic period. So yeah, for this type of companies, let's look at the 10-year. We are now pretty close to the 10-year mean for all of the metrics here. And of course, we have to look at the major competitor here, which is Mastercard. And Mastercard is more expensive than Visa for most of them, most of the things here. So yeah, they're expected to grow double digits in the next coming fiscal years, sales, and 12 to 14% year-over-year growth as well for EPS. And it's a company that you buy and hold for a long time. For a long time. Let's Mastercard compared to its 10-year mean is okay. It's a bit of the same. Mastercard and Visa are really close to their 10-year mean when it comes to valuation, but both of them are companies that have increased free cash flow, that have bought back their shares, pays a nice little dividend. So yeah, great companies to hold for a very long time. Here as well, Mastercard, you got 11 cents 10 years ago. You're now getting 57 cents. So really can't go wrong with these behemoths. So yeah. I mean, look at this. 10 years ago, Mastercard was trading at $83. We're now at $419. But if the big jump was, well, we dropped here, trade war, right? End of 2018 was around $200, also 176. And since then, it has increased quite fast. And it's basically the graph for a lot of tech companies. And people need to realize that this is a trend that is quite normal, in my opinion. Companies can generate more profits, more revenues, while putting less money at risk. That's why we're seeing higher multiples across the board. The reason why a company gets a higher multiple is because, well, it's worth the premium. It means that it can grow faster. It means that it can generate more free cash flow, more earnings, while having to put less cash at risk, meaning less investment, more profits. And the whole tech sector, this whole fintech sector as well, they can do that right now, thanks to AI, thanks to increased technologies, machine learnings, cloud, computing, whatever. So yeah, I mean, usually what we've seen before, right, in the past, 30 times forward PE, incredibly expensive, right? If you asked someone 10 years ago, 15 years ago, 20 years ago, this company is trading at 30 times PE, 50 times PE, even 25 times PE, people would say, super expensive, I'm not touching that. I'm not going to touch this company. Which, okay, fine. 15, 20 years ago would have been correct. And this again goes back to the same, in my opinion, dumb argument of people comparing the AI bubble right now to the dot-com bubble. There's no comparison. There's nothing to compare that. We have trillion-dollar companies right now that are generating hundreds of billions of dollars in revenue, billions and billions of dollars in earnings, billions of dollars in free cash flow. I mean, there was nothing back then in the dot-com bubble that can be compared to what we're at right now. And these companies are still increasing their earnings each and every year, increasing their free cash flow each and every year. Yes, some companies are in a bubble right now. Some companies are going up thanks to the AI hype just because they integrate some product with regards to AI or their offerings, whatever. But overall, the whole market, I don't think we can compare it. I think it's the dumbest thing to say, oh, right now we're in this bubble, and that's because, yeah, in 2000 there was a bubble, tech bubble. Back then there was a lot of money, no tech. Today you have tech and a lot of money as well, and a lot of profits. That's the big difference here. So, yeah, we're going to continue to see these high multiples for years and years to come. You're going to see these companies increase their earnings, free cash flow for years and years to come, because AI is like something we've never seen before. This is going to change each and every year. The rate of improvement is much, much faster than before. I mean, the internet has already changed quite all of our lives, actually, a lot of these companies as well. AI is going to do that as well, but much, much faster, in my opinion, of course. So yeah, with that, I think it's time for me to go watch a movie and relax a bit. Or maybe I'll first prepare the Tesla video, and then I'll go watch a movie. So thank you all for joining. Watch Sunday. There won't be a Sunday stream because I unfortunately have to go visit a friend who lost his grandfather. So no stream on Sunday. So we'll be back on Monday. See you all on Monday or in tomorrow's video, and have a great weekend. Bye-bye.